HODL is a terrible strategy when it comes to crypto because escheatment kicks in. And so the hold on for dear life crowd who's kind of ridden this wave over the last couple of years
log in, folks.
Please log in. Please log in.
Hello and welcome to In Control, where we learn about the finance of everything. I'm Tash, your host, and I'm also the CEO and founder of Cable, which supports the show. When I was a kid, I would receive a little bit of money from my aunts and uncles and grandparents for Christmas. And in January, I would take those checks to the local building society and deposit it. I had this little blue book which I would take with me. And every time I deposited a check or withdrew cash, they would take my little blue book and print a new entry into it showing what the running balance was. When I was 19 or 20, I bought a car with the majority of the money in this account and consequently completely forgot about that little blue book. Apart from now, 15 years or so later, I receive a statement to my mum's house back in England once a year, detailing my savings in this building society. I think there's maybe £300 in there now. I have definitely long ago lost that little blue book, and I could not tell you the name of this building society if my life depended on it. Fast forward many years, and during one of the many Bitcoin spikes during COVID, I opened a Coinbase account and bought maybe £100 worth of Bitcoin. Since then, I have moved to the US and no longer have that UK phone number with which I opened the account. I've tried to get into my Coinbase account, but because I'm in the US, I've not managed to. And this money that I can't really access, sure, it's only £400 or so. What happens to it? Does it sit there forever? Do these financial institutions continue to make money from lending out my deposits even though I can't access the money? It turns out that there is this thing called escheatment. Escheatment is a legal process where unclaimed cash or other property transfers to the state government after a period of inactivity. And I want to understand how this works and how I can get my money back. And it just so happens that there is a company, Eisen, helping banks and fintechs with this process. So today I am talking to Eisen's CEO and founder, Allen Osgood. Allen, thank you for chatting with me today. And I want to start by asking how you ended up building a company in such an important but admittedly niche space.
Yeah, well, Tosh, nice to chat, and appreciate you having us. So, my story with escheatment actually starts a number of years ago. So, prior to this, I was the payments PM at Coinbase, and one of the many things that you get to do when you're helping open bank accounts and kind of set up payment rails is bring the stack of compliance policies and things to those bank meetings. One of those things that we saw in that was this one line that said, "We help comply with escheatment rules." That's great and all, but then you fast forward and you start hearing these stories about liquidating millions and millions of dollars of people's accounts. In crypto, securities, and all non-cash assets, you're actually required to usually liquidate the items, which then causes all sorts of problems. But then fast forward again, and it's kind of the story of these things follow you. There's a NPR Planet Money podcast called The Escheat Show, which the puns in the space are just hilarious. But it tells the story of a guy named Walter who bought Amazon shares in the 90s, put them into his E-Trade account, thought it was a good investment, and did kind of what we're all taught to do, which is set it and forget it and let it go up. Turns out that's a terrible idea. HODL and set and forget doesn't apply when there's escheatment rules. So escheatment is every different state in the US and 40 plus countries around the world have inactivity or dormancy period requirements that require financial institutions, general corporations, a whole set of people that hold money for somebody else for whatever reason, after somewhere between 1 to 5 years of inactivity, to close those accounts, send the money to the relative, whoever the government is there, and actually allow them to claim it from the government. And it traces all the way back to like ye old English rules where the crown would bestow property upon you. And if you didn't use it or you abandoned it, it would revert back to the crown. When we're talking like feudal lands, that might make sense. When we're talking fintech wallets, checking accounts, crypto wallets, brokerage accounts, IRAs, the broad suite of different types of financial instruments that have kind of ballooned over the last decade or so, it doesn't really make any sense anymore. And so most things across the US, the average dormancy period is about 3 years, which means right now, every account that got opened up during COVID, that whether it was a marketing bonus or a thing you're just trying out, is now actually up for escheatment. And so what that means is these companies, whether a fintech, a bank, a credit union, whoever, they're going to look at all of their accounts, apply the full suite of state rules. If it goes dormant, according to that state for that property type, they're required to send you physical mail like first class mail, certified mail, different requirements. If you don't reply to that, if it's non-cash, they have to liquidate it. They then take the money, report it to the state, and then remit the funds to the state. And you and your blue book should be able to be picked up from there's a government website called missingmoney.com where you can actually search whether or not you're owed cash from any of the states in the US. And different jurisdictions globally have different ways that you kind of reclaim your money. But the idea being there's this entire suite of different types of accounts and funds that you can have today. If you don't use them, those companies are required by law to actually close those accounts and send them to the government. If they do it, you get pissed off as the consumer. If they don't do it, they get audited and fined by all of the states. So it's really a catch-22 situation where, especially as you think about how the proliferation of digital finance, everybody being a fintech, that's great until people stop using your stuff. They could die. They could simply have multiple accounts and not be using this one. There's a whole range of reasons why things go dormant. But when they do go dormant, people are required to take action.
Wow. Okay, there was so much there, and this is awesome because we're going to have a great conversation. I guess since you worked at Coinbase, maybe you can help me get my $100 back. But wait, I want to find out what happened to this guy on the NPR podcast. Did he manage to? So presumably, the story is that his Amazon shares got liquidated and got liquidated.
Yeah.
And
so let me loop back to Walter. So Walter bought about $6,000 worth of Amazon stock in the 90s. He then set it and forget it. Didn't log into his account for decades, then went to retire in the late 2010s, only to realize that when he logged in, he saw a big fat zero in his account balance. So he freaked out. He called the support agent, and for the first time in his life, he heard the term escheatment. There's the NPR podcast tells the story of his kind of saga to reclaim what he thought was one of the best investments you could make. If you remember, Amazon from like the 1990s to early 2010s didn't do a ton. And then 2010 to 2020 exploded. One of the best investments of the decade. And so his 6,000 got escheated when it was worth 8,000 in about 2008, not the hundreds of thousands that he thought he was due, which he built the bedrock of his retirement on. And so he put it into his E-Trade account. So he sued Morgan Stanley, he sued E-Trade, he sued the state of Delaware, he sued anybody he could find, but they'd all followed the escheatment laws. And so in this complex like set of rules here, E-Trade did what they were supposed to do. They sent a letter to his address on file, but he'd moved, and the national change of address didn't route correctly, so we never got the letter. They then took it, sent it to Delaware. Delaware liquidated it, as they're supposed to do in their policies. And at the end of the day, Walter was told, "Hey, we have your money. Here's your $8,000," and he's suing for the hundreds of thousands. He's lost all of the cases so far. He's still kind of going through the process, but it's just a sad story where everybody, quote unquote, did what they were supposed to do. But the right answer for E-Trade isn't to necessarily like wait until 3 years of dormancy and then turn around and liquidate it. It's to find the new address for Walter. And so what we focus on is first off, you have to help people comply with the rules. That's not really an option. But once you do that, you can actually get really proactive on trying to retain these assets, which is the best answer for everybody.
Wow.
Escheatment is a breakup fee with your client, with your customer. If you do it, they don't like you. If you don't do it, the state gets mad at you. But if you can reestablish contact, find that new address for somebody, you can actually retain the assets, which is both better for the consumer, and you also get to keep them for another 3 to 5 years.
Yeah.
So in all of banking, the kind of net interest margin benefits, the retention benefits, and the client relationships get to continue.
Okay. Wow. This is so cool. So let's start slowly and like really build this up. So, what kind of company has to comply with these compliance requirements around escheatment? Is it just regulated FIs? Explain that to begin with. Who has to comply with this?
Sure. So escheatment affects a large swath of the kind of corporate population. So these are companies. This could be anyone from Uber of driver payouts that don't go out the door to Disney and accounts payable checks, vendor checks, payroll, to bank accounts, to treasury management systems that send out checks that don't get cashed. This actually is a huge, to brokerages with brokerage accounts, to life insurance companies with death benefits. Any payment that's owed to somebody else that doesn't actually get cashed or delivered becomes unclaimed property in the eyes of the states and all of the auditors that are associated with this process. And so we have an extremely horizontal, escheatment's a very horizontal problem. And so one of the things that we've gone through and do, we started in fintech, both based on my background and some early client wins, but we're starting to see dramatic expansion within banking, within credit unions, within brokerage, and increasingly within kind of traditional corporates.
And so that last bucket is really interesting. So if you are just a a regular cable, this company that I run, we owe, let's say, our accountants 10 grand for the R&D claim that we put in last year, and we decide to send them a check. Let's say we send them a check and they don't cash it. Is that money that, in theory, cable has to escheat in 1 to 3 years' time?
Correct.
Oh, wow. Okay, so this really applies
So
to any corporate that is paying
to
anyone
any
else.
corporate, and it's two-sided. On the accounts receivable side, it's credit memos you've issued that have not been used. That's considered somebody else's property. On
Huh.
accounts payable, it's whether it's an ACH, a wire, a check, the modality doesn't really matter. It's the fact that there's a contractual obligation that you're trying to fulfill to pay somebody else that has not been successful. That means that in the eyes of an auditor, that's their money. So in the context of like fintech for a second, you think about offboarding. Everybody spends millions and millions of dollars on opening up accounts, on getting people activated, but these things end up churning at a natural rate. So what happens when you have somebody's money for years that they haven't used? You need to disperse that to them. If they don't cash that disbursement, you need to prepare to escheat it. And then finally, you can kind of write that down to zero out that balance. But whether it's accounts receivable, accounts payable, it's all kind of two different flavors of the same other people's money that's actually owed there.
Does it also apply to assets that are easy to liquidate, but not necessarily like financial? So, for example, like, I don't know, if I buy a car and I pay for the car, but I don't actually go and pick up the car from the auto shop, can they liquidate that and escheat that? Like, is it also those sorts of assets?
The kind of funny thing here is like the storage unit, right? So like
Yeah,
imagine
yeah, yeah,
somebody has a
exactly.
storage unit. You run an auction on those things. They auction that off, and then what are they supposed to do with those proceeds? It's an entire world of like, what do you do with physical assets? That's not where we play. That's not our kind of focus as a company, but that is entirely within scope. Most of the states are focused on the intangible property, so they care way more about getting the death benefit to the beneficiaries than they
Hmm.
do about the unclaimed car on the lot going somewhere. But that is exactly where we're kind of talking about this core issue. And
Okay.
so the breadth of companies that have to go through and do these reports, it's in Florida has 150,000 companies that have actually filed their unclaimed property reports with them. And so when we start to think about who do we go help, where do we plug in, fintech and banking and credit unions have been fantastic on the regulated FI phase because they focus
Hmm.
on this, but it's a much, much broader set of folks.
Yeah. Okay, that's fascinating. I did not realize that. And so then let's build up for our listeners the actual steps that a bank or a fintech, let's just focus on that for now, what steps they actually have to go through in order to comply with the requirements around escheatment. So build those up for us. What are they?
Sure. Let's say I'm payments operations at one of the kind of main fintechs here. So I have clients who've sent who have balances with us. Um, Usually those customers are nationwide.
Hmm.
Escheatment laws apply in there's called two priority rules. So priority rule one is if you have an address on file for that person, that's the jurisdictional rules that apply.
Hmm.
If you don't, then it falls back to the state of incorporation of the business, usually Delaware in fintech and finance. And so what happens is the second you launch support for customers who are able to move, even if you're a 2 or 3 state community bank, as soon as you have a customer in Florida or that moves to Michigan or that moves to California, you've now expanded your escheatment footprint to whatever states you have on file in terms of your customer base. And so complying with the rules requires you to have a nationwide footprint of understanding of these things, which a lot of the places that we help aren't equipped to do.
Okay, so
And so,
let's just pause there for a second. So Chime, huge fintech, public fintech in the US, they, I don't know, but let's say that they are incorporated in Delaware, which wouldn't be a huge leap. Their main offices, though, are in California, and they have customers, they have users in all 50 states of America. They have to comply with 50 states worth of escheatment laws, which might all be different. And then if they can't find that address for those customers, they have to go to Delaware, those laws. Okay. Wow.
correct.
And how
So
different are the states' laws from each other?
it's a pain in the butt. So the first thing that you have to do. So let's say Chime has a million accounts. I actually think it's a lot higher. So Chime needs to take those million accounts, look at the balance in each of them, look at the last activity date associated with each of them, apply the state-specific dormancy period to figure out when it's quote unquote abandoned. Then you figure out which reporting cycle that falls into for the state. Usually, most states run from a July 1st to a June 30th reporting cycle. So if it goes dormant in that window, it becomes reportable the following end of October, 1st of November. And so that's your reporting date. Then you back up to when you need to send due diligence. Usually it's somewhere between 30 days to 90 days before it needs to be reported. Customers then have a period of response window. Then you can actually report it. Then you can remit it.
Okay,
And so
let me make sure I understand that. So every bank or fintech in this example chime, they have to track and sort of keep a record of the last activity date on the account. Let's pause there. What does an activity mean? Does that just mean a transaction, or could that be like communicating with customer support as well?
So most companies will take into account transactions and login dates as the primary items. One of the first things we help our customers do is pull in activity data from logins, because that you would usually plummet the amount of items that you have quote unquote
Yeah,
dormant. A lot of fintech has become I keep my balance there and I check it once in
yeah,
a while
yeah, yeah,
as
yeah.
opposed to constantly transacting with it. But usually there's systems not talking to each other problems. That means that those login dates don't actually get tracked at the account level.
And
And so
presumably, like those login dates are tracked much more effectively and fully for modern fintechs than for banks.
correct. So now, if you're in a modern bank scenario, you're integrating data from the like digital login experience and the
Hmm.
digital banking portals. And so, how you start to connect all the pieces together when achievement is not really something these places can dedicate engineering and product resources to. This is not a value added service to their core competencies, which is where we've been able to plug in and help a lot of these folks.
Isn't that
So
so? It's like the compliance doom that we live in. It's never revenue generating, it's just required.
And the thing that we've seen though is that there is most states allow you to charge an escheatment fee as part
Huh?
of your terms of service. And so if you have a like validly enforced contract, it's not regularly reversed, and a couple of other specific requirements. We see fintechs and banks charge anywhere from $10 to $50 as an escheatment fee to offset their costs of what they have to do here. And so everybody kind of gets to take their lens on what is an appropriate fee for a service like this, but it's something that we see pretty commonly.
Okay,
And
let's
so,
let's back up to that. I want to get to that in a second. Let's keep building
sure.
this up. So,
All right.
the fintech in this case, Chime, has decided that the customer has been dormant. So they have not logged in, they've not done a transaction, which has all been tracked through the login data and the app usage data for the period of time that's required in that state. And if you're Chime, you've got 50 states to deal with. So you've got to look at each customer, determine which state it is, and then apply that state's length of time, which they deem to be like the period of abandonment. Correct so far? Okay, cool.
Yep.
So
Nailed it.
at that point, they've then got, so let's say that reporting period ends July 1st. They have is it another year and a half then to report it, or
Another
it's that
four
October?
months.
Okay, so it's 4 months then. And so if somebody gets to the end, it's like June 20th, and the customer has not logged in for the 3 years or whatever the appropriate period is, the fintech then has 4 months before they have to actually comply with escheatment laws. In that 4 months, is there a number of times that they legally have to try to contact the customers?
So let's talk about legally required minimums and then go to typically what we would encourage folks to do.
Okay.
So you're looking at a set of accounts that has been dormant at least somewhere between 1 to 5 years, usually free. If you're dormant 3 years as of July 1st, I'm now required to send you a piece of mail in most states, that couple of different types of mail, but I send that letter to the last address I have on file. The challenge we see is that the address we have on file for a 3-year dormant account, how many times has the average American moved over the course of 3 years? And that's all over the place. And so the delivery rate on these things is pretty low. But let's say instead you log into your account, or we're able to somehow reactivate you between when you went dormant and the reporting date. We get to pull you off the escheatment list. You're still an active customer, and our goal is to retain you. The in that mode, you have a list of what we would call the initial achievement list as of July 1st. You take actions to try to reactivate people, and then you finalize the achievement list before you actually go through, report, and remit the funds. But I would argue there's a little bit of losing the forest for the trees if that's the approach you take. That's the minimum. The benefit of knowing when something's going to be escheated is that you can back up as to when you should start trying to reactivate this person, which is not 4 months before you force close their account. It's years before you force close their account. And so how do we put in place more of a proactive outreach, more of a retention strategy before you have a 4 month scramble to actually go through and try to get this person to like answer the phone, write you an email, log into their account? The whole process has been reactive for decades, and our goal is to try to make that a much more proactive one.
Oh, I now fully get the business model behind Eisen as well. So this is not about escheatment. This is about trying to reactivate and retain deposits for banks and fintechs to increase their deposits and their sort of the money that they can then lend out and make money on.
Entirely. And so priority one is make sure you comply with the rules. Like we have to give you a rule set by which you can dump millions and millions of accounts through our system, understand exactly what needs to happen for each of them, but then we can offer you the entire set of tools to reactivate those people. How do we look up new login information? How do we check if you're subject to SCRA protections? If you go to liquidate a crypto account for an active service member, you're directly violating SCRA protections. And so when you start to think about all the input signals that you actually need to check for to make sure that you're complying with the right set of rules in the right place for each of these accounts, it's a mess that these people try to manage themselves. It's completely undoable.
And you have to send this piece of mail, but can you also presumably email and text and use whatever other contact information you have about these customers, right?
For just the largest ones, some people hire like PIs to go
Okay.
find them. We're talking, you can throw the kitchen sink at retention.
Yep.
You just have to establish contact with that person in a provable written way.
Okay. And so presumably one of the benefits that Eisen then has and can provide to its customers is if you see Natasha Vernier, you successfully reactivate me with Chime because they have an address on file for me in California. And then Natasha Vernier with the same date of birth is in the escheatment list for, I don't know, Mercury's account. But they have a different address. Presumably some of the value out of Eisen is actually, we suggest you try this address.
So obviously different clients have different appetite for what they're willing to participate in a reactivation network, which is exactly what you're describing. But that's one of the core pieces. How do we provide network-wide signal for the identity layer of each of these people? Because we'll know who's dormant. But for a lot of our clients, they send us way more than just the dormant accounts.
Yeah.
They send us the full set of people to evaluate against these things as we help them with more and more of this stuff. So we might have an address for you over here that's 3 years old, but we might have a new address for you on your new account. And so as our business and clients continue to expand, there's a natural network effect that plays out with exactly the point that you just made.
Okay, this is so cool. And we've got so much still to cover. So we need to move on. Let's talk about, you mentioned fees. You can charge an escheatment fee. Does that just come out? So let's say Chime has gone through this process of trying to reactivate a customer. They've not heard anything. This customer is on the final escheatment list. The money is going to be escheated to the state of California or Florida or wherever this customer is. Let's say that in Chime's contracts that the customer has probably not read but has approved because the world today, it says that they can charge an escheatment fee of $50. Does that just then they hold that back from the money that they escheat to the state? Is that how that works?
Correct.
Yeah.
Correct.
Okay. And then they literally just sort of transfer this money to a state-owned bank account. Is that right?
So entirely correct. So you would file, if you imagine it as you send one lump sum payment to each of the states, then you send them basically a reconciliation file of the individual PII and information for each account. So one of the benefits that we help our clients with is facilitating accounts payable. So instead of you having the accounts payable instructions for 54 different jurisdictions around the US to make sure these things get delivered correctly, we can help you orchestrate that process. And so helping with the kind of reporting and payments to each of these different states is a core part of that compliance process. But escheatment broadly is 5 steps. Identify which accounts are dormant according to the correct jurisdictional rules, send due diligence, finalize and report those items, remit a property to the states, and then prepare an audit package because somebody will be knocking on your door coming to make sure that you verify that you did this correctly.
Fascinating. Okay. And how big of a problem or of an issue is this? How many people have money that has been escheated to states? Is this like a big problem?
So people estimate that the states today are holding more than $70 billion of other people's money. The state's incentive is that they get to keep the interest. on most of these funds. And so then the states use this to fill budgets. Ohio recently proposed using it to fund a football stadium. There's different usages for these things that kind of fill state coffers, which makes the space kind of adversarial. But the normal industry estimates are that there's $70 billion of funds being held by states, and it affects more than 1 in 7 Americans. And so that missingmoney.com search my record so far is someone found 10 grand by going to search these things. But there's public stories of companies that had to escheat hundreds of millions of dollars and individuals who then end up finding hundreds of thousands of dollars from estranged parents' death benefits, from all sorts of different old brokerage accounts that got liquidated and forgotten about. The different ways that you can store money in the current financial system, as that's expanded, this has become a worse and worse problem.
Okay, I'm going to get onto the states making interest of this, because that is a whole thing that we should talk about. But before we get there, you just touched on something that I think is really important to talk about. Has this escheatment problem, the amount of money being escheated, has it just ballooned over the last 10, 15 years with all of the, the myriad of fintechs and different types of trading accounts you can have and crypto and all of this? Has it just ballooned?
It's grown significantly in that the importance of the marginal financial account in our lives has gone down significantly as to what it was when these things were put in place 40, 50 years ago.
Mm-hmm.
And so if you think about the number of accounts that the average person has today, it's way higher because everybody's incentivized to help you open accounts. However, those things, there's a natural capacity as to how many accounts I'm going to use on a regular basis. And so what we've seen is this kind of huge tailwind behind all of the kind of fintech, the sponsor banks, the new era growth fintechs. What that's starting to cause is more and more people who have to start complying with these rules. But actually, crypto is the most rapidly evolving space here. So as we think about crypto wallets and offering those services, as we think about stable coins and offering those services, as you get into crypto is an escheatable asset. And in California, as of January 1st, 2026, now all unclaimed crypto to California owners is due this fall. That has ever been 3 years dormant backwards looking. So the entire crypto space is headed for a massive awakening as you see companies start liquidating hundreds of millions of dollars of people's assets to then turn around and send cash to the states, because the states don't know how to hold crypto yet.
Yeah,
so they want cash. And so as we start to think about some of our clients are kind of the large name brand fintechs that offer crypto services, that's a huge thing that's going to hurt a lot of people.
Oh, damn. So if I've understood that correctly, this is the first year that crypto companies have had to comply with escheatment rules. Is that right?
In California.
Yep,
which is one of the largest. California kicked in this year. New York kicks in next year or the following. The biggest markets are turning on these types of requirements for crypto specifically.
And when a state turns that on, so let's go back just a second. I want to make sure I understand this. So California has just turned this on for crypto. So that is any customer of, for example, Coinbase, whose address is in California, not the companies based here, right?
Correct.
Okay.
So any customer who's based in that state, who's not logged in for 3 or more years, is going to be reported for the first time this fall.
Oh, interesting.
And when that happens, it's going to be a huge wave of all of these things. There's an article that came out last year where Coinbase had to escheat $270 million of crypto assets for international owners to Wyoming, based on the way that entity was structured. It went to unknown addresses, went to a specific state. And so we're seeing huge volumes come through these rails where people have kind of played around with new asset types, made investments here. HODL is a terrible strategy when it comes to crypto because escheatment kicks in. And so the hold on for dear life crowd who's kind of ridden this wave over the last couple of years is
log in, folks.
Please log in. Or eventually we're going to have to send you a letter. And if you don't log in, we're going to have to.
If you've moved and you don't get the letter, goodbye.
Please just log in.
Oh my God.
But that's kind of one of the core concepts here is how do we help reunite people with their money? Because the best outcome is not doing escheatment at all. Yeah. If we can reconnect people with the institutions that are holding their funds, those institutions aren't required by law to then send it to the state.
Have you thought of building a consumer-facing SDK that fintechs can incorporate into their product that helps them find lost money and put it in that fintech's app? So like you should sell an SDK to Chime, find if you've got any lost money, and let's say the money was with JP Morgan or someone else, the goal is to then deposit it in Chime.
I think you should come to our product brainstorm sessions. I think you'd have a great time. This is something that I think absolutely should exist, and I think but it's a difficult challenge because it's the first time that somebody's going to be trying to do, knowing bank provided levels of information about clients. How do I? It's in their incentive for me to reactivate this person.
Yeah.
So how do I then get the opt-in on the other side to then connect inactive accounts before it goes to the state in the first place?
Oh,
So
yeah. Okay.
shortcutting the escheatment process, I think, is going to be a really unique thing that as we continue to grow and build the identity graph that you were talking about earlier, that becomes more and more valuable to each of these places.
That's so interesting. Okay, so let's talk about the finance of escheatment for a moment. It sounds like if Chime is holding my money, but I haven't logged in for 3 years and it's making interest. Let's say my deposit has gone from $100 to $200 through interest over the last 3 years. It is the full $300 that would get escheated, right? I get to, in theory, keep that interest even though it's escheated to the state's bank account. Is that right?
Correct. So the full amount of the money Chime owes to you goes to the state, but the claims process at the state level, states are not fintechs. You're not going to have a smooth, nice KYC process to then re-verify your identity, because what happens is the triangle of customers give money to these companies. Companies are forced by unclaimed property laws to give money to the state, and the states, through their own processes, decide which claims to pay out to other people. But the people claiming money from the state is one of the most rife areas of fraud in fintech, because it's free money held by the state governments. If I claim to be Tasha at to the state of Florida, where I see that you have on a publicly available list thousands and thousands of dollars, that person, that poor claims person at the state of Florida's treasurer's office, is going to have to determine whether or not this is a valid claim. And so that process of claiming the money is actually one of the biggest nightmares here, which is why when things get escheated, industry standard here is that 66% of those items will never get claimed. They will actually sit there forever in perpetuity.
And so do you also help the states return the money?
There's an entire industry that does that. We don't play there today.
Okay.
These are called finders. So what a finder would do is they'd say, okay, Florida, I see, please, I'm going to FOIA the list of items that you have for people. I'm then going to go reach out to those people and I'm going to claim a percentage of the funds that I help reunite. Great business model for people that want to play that game. We facilitate today the transfer and compliance of companies to the states, and then the reactivation of people before the money gets to the state in the first place.
Okay, cool. And so then the money is with the state. This $300 that I had in Chime has gone to the state. And what you said earlier, so the states can make interest off this $70 billion that's held across all the states in America, and they just get to keep it. It doesn't go back to the consumers.
And some states are starting to think about changing their rules here, but by far the standard is that the state that accrues to the state's treasury fund, which is one of the reasons that the states. Let's talk enforcement for a second. So, what makes companies do this in the first place? The states are usually wildly understaffed. The state of Florida has 6 auditors to then audit all of the companies, the hundreds of thousands of companies that need to file here. So what has happened in the space is that they hire contingency fee auditors. So large scale audit firms like Kelmar and others get paid 10 to 12% of the interest, 10 to 12% of the money that they're able to claim from these companies. And so it's a contingency fee model where the states incentivize audit firms to then chase down the large scale companies who aren't reporting. And so they have all sorts of data analysis and data science running on which companies aren't reporting that should be. So when you see huge headlines of large scale raises or huge fintechs or IPOs, one of the first knocks those people are going to get is an audit request from one of these multi-state auditors who then, as an example, not that I know anything about Chime here, but let's say that Chime IPO'd, they've never been audited before, and somebody notices that they've not filed reports here. That auditor is going to go knock on all their friends' doors at all of the different states and say, hey, we're going to go audit this company. Would you like to join? They participate, pile on, and then you end up as the Chime payment operations person getting an audit request from 40 plus different states.
Oh my God. Okay. So from the bank's perspective, they can continue to use the money until it is escheated. They also have to continue to pay any interest. From the state's perspective, they are actually incentivized to go and try to escheat money, and any interest that they make on the money that has been escheated to them, they get to keep. And so they are also then not incentivized to return this money to any consumer or business that is due this money that the state is holding.
This is the set of incentives that has turned a consumer protection regime into something that the states use as budget fill.
That is
And so the
crazy.
behavior that you see play out here, Illinois as an example, they keep shortening the dormancy periods.
Yeah, I bet.
Dormancy periods weren't always 3 years. They used to be 5 to 7. And so what's happened is as states have kind of woken up to the fact that this is a great, I think this was Delaware's third largest source of revenue behind income taxes and property taxes.
Oh my
So
God.
when we think about the volumes of funds flowing through here, it's a messed up incentive system to protect consumers.
Yeah. It doesn't protect consumers at all. And they stop making interest on money that maybe they have left there, just like our friend Walter on the NPR episode.
And the reason Morgan Stanley or E-Trade does this is that they're going to face 10% per year penalties and interest fines on anything that they should have reported that they didn't.
Okay,
So when
so
that
let's dig into that. Sorry, 10% of what they should have. Click in on that and explain that in more detail.
So we just talked about the audit enforcement. So these
Yep.
audit firms who come and knock on your door, they ask for all of the information and books and records on the accounts for what would be escheatable.
Mhm.
They then do the same analysis we talked about. It should be 3 years for this property type, 5 years for this property type. But this says that you should have escheated this 3 years ago. Why didn't you? Now we're doing math on what the interest rate and penalty is from the state's perspective for you not complying with the rules. So there's been numerous large scale like settlement agreements where massive scale banks down to your local community bank get fined for not doing this. There's a really kind of well-known article from the state of California where the Attorney General Bonta went after a healthcare system that refused to file unclaimed property reports, and they went after them for treble damages. So $1.5 million in unclaimed property turned into a $7.7 million fine. And so when you start to that healthcare, these were patient refund payments that didn't end up getting cashed as checks, and so they used them to set an example that you have to follow the rules for this, and that type of penalty assessment is what plays out quietly behind the scenes at all of these different places.
But the standard wow. And the standard is 10% per year, did you say, of what was not escheated?
Exactly. So let's say that Walter's account, they didn't escheat it when they were supposed to. Say it was $1,000, then 10% interest and penalty per year cumulative until it was actually reported. And so New York, I think, is one of the specific ones that's 10% here, but it varies per state, but it becomes an enormous amount of money.
Let's play that Walter one through for a second, because what's interesting is it might have been beneficial for E-Trade to hold on to the money given it was Amazon stock in that period of time. So presumably it would have been 10% of the amount that should have been escheated at the date that it should have been escheated. So I think you said it was like $8,000. 10% of the 8,000 every year? Or if next year suddenly the Amazon stock has gone up and it's worth 100,000, is it now 10% of the 100,000, or does it stick with the amount that it should have been escheated at the date that it first should have been escheated?
It's a dangerous game because you don't know whether the stock's going up or down.
Sure.
So if the stock goes up, the customer is going to be upset with you because the amount that they should have gotten on the other side of this went up. If the stock goes down, but the way that the penalty assessment works is it's usually a snapshot at like whatever the year should have been when it was reported.
So in Walter's case, when it was escheated, it was $8,000. Let's say by the time he wanted to sell it, and actually came back to the E-Trade account, he was expecting to see $200,000. It would only have been the $800 multiplied by the 10 years or whatever it is. So let's say $8,000 that E-Trade would have had to have paid in fine, but Walter still would have got the $100,000.
Correct. The challenge is that if you choose to not comply with the rules, the states are going to be all over you to the tune of treble damages. That changes dramatically if it's willful noncompliance. The standard payment, the standard penalty is 10%. The willful noncompliance penalty goes up dramatically.
Got
And
it. Okay.
so you play with fire at your own risk.
Okay, so this is so interesting. And now I am fascinated in Eisen's business model. Give me a quick rundown of how you work with fintechs and banks and the bits of your product offering that you charge for. Because it sounds to me like there may be two or three or four different types of products or services that you can offer to fintechs and banks, and they probably all have slightly different revenue models.
Yep. So we've tried to simplify it as much as we can because there's many pieces to this
Yeah.
operationally. Our core business model is two items: an upfront annual SaaS fee based on the number of states and the number of accounts for us to process. So if you want to dump in 1,000 accounts, 100,000 accounts, 10 million accounts, we'll set that up as an upfront annual SaaS fee. We'll then help you understand what we would call a your escheatment scorecard. So it's like a state by state breakdown of what's past due, what's currently due, and give you a full risk assessment right out of the gate. The second thing we do is we charge per item processed for escheatment. So when we actually operationalize each of the items for compliance, that's going to include what things need letters, sending those letters, getting the responses back, scanning in the responses, prepping the reports, submitting the reports, remitting the funds. So we'll help you with all of that kind of a specific, normally kind of a dollar value per item processed as we go through. Our core goal is to try to retain people. So we're going to look up new addresses. We're going to make sure like addresses are like deliverable. We're going to see if we have other information that would supplement kind of the contact information that you have. How do we go through and try to retain your customer? Because it's in everybody's interest to do so. But the core model, upfront annual SaaS to set up and analyze and load, and then operationally per item processed through the achievement process.
Do you charge for the customers that you are able to reactivate?
So we do. We consider that kind of once we start the process, that's normally our billing item. And then if people want us to do kind of above and beyond items to go above, we always offer kind of upsell items that we can go help with.
Yeah. Fascinating. Okay. So interesting. I guess to finish off, I would love to hear your thoughts on how we can actually get more money back to consumers and businesses. Like, what can we change so that it is not 1 in 7 people that have money with states and $70 billion? How do we actually change that?
I bucket this into two categories. There is how do we take the money that's already been reported to the states and get it back to consumers?
Mm-hmm.
And then there's how do we help prevent people from being escheated in the first place? And so what I've come to appreciate is that there's no single entity that knows all of the different accounts that you have unless you link everything to it. So we've seen user permissioned PFMs be kind of the standard model for what aggregation looks like. Plaid being a great example of this. You can build a data network that allows people to link their things. But there's no credit bureau equivalent on the asset side. So the credit bureaus get told by everybody in a bank provided way who are all the bad customers. There's no equivalent asset bureau that says who are all the good customers that then propagates the kind of network updates when addresses change, when people move, when somebody dies. That check systems, I think, is the closest one. But even that's just the largest banks in the US. And so how do you start to think about a identity graph that like knows who people are and helps build a relationship with those people across different institutions? And so as our business continues to grow and we get more and more clients engaged, the value of that network continues to increase because it lets us know, say you turned off of your Bank of America account to a Mercury personal account. Somebody should probably know that happened, such that then if you have some things over here that are about to get sent to the state, you're probably going to be pretty happy that somebody flagged it for you. There is absolutely a long-term consumer play to our business. It's just we've been so focused and so underwater, just making sure the companies are able to kind of come into compliance here. We haven't quite gotten to it yet.
Yeah. Okay. And can you share that website that everyone should go check right now to see if they've got any money with the states?
So if you have money that you're missing, go to missingmoney.com, search your name. It's the state, then it's put together by all the state treasurers and all the unclaimed property administrators. It's the state standard way to go check if you're owed money. You're going to then go through a KYC process. They'll ask for some documentation, ID, those things, but it's usually pretty quick to get a claim, and then they'll send you a check. But if you don't cash your check, the money's going to stay in the unclaimed property fund. So check missing money for the money that's owed to you from the states, and then log into your accounts. Once every 3 years means that that's going to stay open and you're going to be just fine.
Wow. Okay. This was So fascinating. Alan, thank you so much for teaching me all about escheatment. I had no idea it was this complex, it impacted so many people, or that there were so many really, really interesting angles to the business that you're building. So it's been awesome to learn all about it. Thank you so much for joining me on In Control.
Awesome. Thanks so much for having us.